Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, September 18th, and we'll see how things look for Friday, September 19th. Going over the action in Thursday's market session, the major U.S. indexes hit all-time highs. The Dow, the S&P 500, NASDAQ 100, and Russell 2000 small caps all climbed to record levels, reflecting strong bullish momentum. However, the S&P 600 small cap index lagged, signaling some divergence. Despite these highs, internal market strength shows cracks. Indicators including the advanced decline line, the Chaiken Money Flow, and oscillator reveal a weaker condition in the S&P 500 with modest gains of 0.48% on above average volume. Sector performance was led by tech, particularly megacaps and semiconductors, with broad-based participation. Growth stocks outperformed value across the large, mid, and small caps, while discretionary stocks outperformed staples, a positive sign for market sentiment. Going over the economic data provided a mixed backdrop. Jobless claims fell to 231,000 from 264,000, beating expectations and easing labor market concerns. The Philadelphia Fed Index surged to 23.2, well above the forecasted reading of 3, driven by higher orders and lower prices paid, a sign of growth without inflationary pressure. However, the leading economic index declined by 0.5%, raising some caution about future activity, though coincident indicators remain positive. The 10-year Treasury yield rose to 4.1%, holding above the 4% level, while the dollar ticked higher but remains in a longer-term downtrend. Gold continues its remarkable run, up over 120% over the last 3 years, fueled by ETF and speculative flows. On the flip side, declining housing permits flashed a potential recessionary signal, though this hasn't yet dented market optimism. Looking at market indicators and sentiment, short-term technicals, including the Stochk RSI, Williams %R, and CCI charts, continue to show short-term positive conviction. The NYSE advanced decline line also hit a record high. However, concerns linger. Negative divergence in the smart money indicators, including the Chaiken Money Flow and oscillator, coupled with the S&P 500 trading 10% above its 200-day moving average, suggest the market may be overextended, a historical caution zone. Investor and sentiment is positive but not yet euphoric, leaving room for further upside before potential capitulation. Low retail investor confidence could also fuel additional gains if they chase the rally. Looking ahead to Friday, September 19th, the market bias remains positive across all time frames. The S&P 500, which closed at 6632 after hitting an intraday high above the 6650 level, is above key resistance, which could now be acting as support. A close above R1 at 64.68 would maintain the bullish momentum. So far for the week, the S&P is up 0.72%. We'll still be keeping an eye on the 6650 level as overhead resistance due to gamma exposure and the 20-period moving averages for support if there is a pullback. Friday is options expiration day, which could spark volatility. No major economic reports are due to be released. Geopolitical events or market internals may drive movement. Late September is historically weak for the markets, but this hasn't materialized in 2025 so far. A quiet session is possible, though traders should stay vigilant, and there may be volatility due to options expiration. In conclusion, the markets are anticipating further Fed rate cuts in October and December. Goldman Sachs is projecting a dovish path to 3 to 3.25 by 2026. While valuations remain elevated, this hasn't triggered a major decline in recent years. In summary, the S&P 500 and major indexes remain bullish, but internal weaknesses and seasonality warrant caution. Keep an eye on the technical levels and sentiment shifts for signs of continued strength or a potential pullback. Thank you very much, and I will talk to you in the next podcast.